Hello everyone, and thank you for joining today's True Trading webinar. I'm excited to be here with you. My name is Mohammed Azim from Traders United. Risk disclaimer: True webinar house rules. Please take the time to read important rules for webinar attendees. Let me start by sharing a little information about myself. I am a certified Elite Wave analyst, having earned my level 1 certification back in the year 2012 with a score of 93%. This certification deepened my understanding of market behavior, especially through the lens of Elliott wave theory. In addition to my work as an analyst, I am also an author and educator. I wrote Introduction to Elliott Wave Theory, a book designed to help traders like you build a strong foundation in understanding the intricate structure of market waves. But my expertise does not stop at Elliott Wave. Over the years, I have expanded my knowledge into broader market analysis, diving deep into market trends, chart patterns, and price action strategies. So whether you are a beginner or an experienced trader, I aim to provide you with valuable insights that will help you navigate and succeed in the Forex markets. With that, let's dive into today's session. These are the main topics that we are going to cover inside today's webinar. Let me talk about macroeconomic events and data releases. I am going to cover previous week fundamental analysis. The first one is the Consumer Price Index CPI related to Switzerland, and we're going to discuss US dollar Swiss franc currency pair. Next one is the German factory orders month over month. This is related to Eurozone, and we're going to discuss the euro dollar currency pair. Okay, what is the Consumer Price Index, also known as CPI? The Consumer Price Index, or CPI, measures the change in the price of goods and services purchased by households in Switzerland compared to the previous month. As a key inflation metric, it is closely monitored by the Swiss National Bank, also known as SNB, in shaping monetary policy. Typically, a higher than expected CPI suggests rising inflation and increases the likelihood of tighter policy, supporting the Swiss franc, also known as CHF. In contrast, a lower than expected print may invite a more dovish stance from the Switzerland National Bank, uh, potentially weakening the CHF and pushing the USD Swiss franc higher. Now, on July 3rd, 2025, we got the CPI report. The previous number was 0.1%. The forecast was 0.1%. And the actual number we got is 0.2%. So the actual CPI reading came in above expectations at 0.2%, indicating stronger inflationary pressure than the market had anticipated. Surprisingly, however, US dollar Swiss franc moved higher following the release, contrary to the typical pattern. Let me show you the chart of US dollar Swiss franc. Go over here. This is the chart of US dollar Swiss franc. So on July 3rd, right over here, we got a bullish price action overall in US dollar Swiss franc. The actual CPI came in above expectation at 0.2%, indicating stronger inflationary pressure than the market had anticipated. Okay, and market moved up. Actually, USD Swiss franc moved higher. So despite the stronger than expected inflation figure, the Swiss franc weakened and US dollar Swiss franc rose, suggesting that traders may have been focused more on external factors such as renewed strength in the US dollar, global risk sentiment, or positioning ahead of US non-farm payroll data. It is also possible that markets viewed the 0.2% print as insufficient to shift the Swiss National Bank current cautious stance. So if we reassess the scenario and the impact on US dollar Swiss franc, the actual CPI higher than forecast 0.2%. This is what we got. And this indicates inflation may be building. Now, this normally supports Swiss franc and would put downward pressure on the USD Swiss franc. However, this time USD Swiss franc currency pair moved up. Let me show you the chart over here. Let me zoom in a little bit. So over here we got a bullish rally. Okay. So this is possibly due to the US dollar strength or lack of Swiss National Bank hawkish follow through. Now the market focus shift, traders may be prioritizing Fed guidance, US macro data, or interest rate differentials over the Swiss print. The surprise move suggests Swiss franc is being driven more by external forces than domestic inflation alone. Now, the broader market context is the S&P remains cautious, emphasizing data dependence as global inflation trends evolve. Despite the upside surprise in CPI, the market may believe the S&P will maintain its current stance unless inflation shows persistent acceleration. Meanwhile, any renewed hawkish sentiment from the Federal Reserve may have contributed to the dollar's strength and the USD Swiss franc move higher. So the key takeaways for US dollar Swiss franc is the CPI beat the 0.2%. Normally, we expect bullish CHF, which means USD Swiss franc is going to drop, but the USD Swiss franc moved up, likely driven by the US dollar strength or global flows. The traders should monitor US job data, Fed commentary, and risk appetite. The conclusion is the July 3rd, 2025 Swiss CPI surprised to the upside at 0.2%, signaling stronger inflation. However, the expected CHF strength did not materialize, and USD Swiss franc moved up instead. The divergence suggests that broader USD dynamics and investor sentiment currently outweigh local inflation surprises. As global markets reassess inflation and interest rate paths, the USD Swiss franc pair may remain sensitive to developments beyond Switzerland's borders. The next one is the German factory orders. We got this data report on July 4th. Now, what is German factory orders, M over M? M over M means month over month. The German factory orders month-over-month indicator measures the change in the total value of new purchase orders placed with German manufacturers. As Germany is the largest economy in the Eurozone, its industrial performance serves as a key barometer for broader regional growth. Stronger than expected factory orders signal healthy industrial demand, improved business confidence, and prospects for future production, all supportive of the euro. A weaker print, however, points to slowing momentum and may lead to expectations of monetary easing from the European Central Bank, also known as ECB, pressuring the euro. Now, the previous number was 1.6%, the positive number. The forecast was 0.2 but in -1, and the actual number we got is minus 1.4%. The report revealed a steep drop in German factory orders, far below the already pessimistic forecast. The minus 1.4% decline signals a sharper than expected slowdown in the manufacturing sector, reinforcing concerns about weakening demand and a broader economic deceleration across the Eurozone. Market reaction and the Euro USD impact. Now, following the release, Euro USD dropped as traders reacted swiftly to the weaker than expected data. Now, this is the chart of Euro dollar currency pair daily time frame. So, or on 4th July, we got kind of a sideways price action, but after that, we got overall 100 pips decline in Euro dollar currency pair. The euro came under pressure as markets reassessed the outlook for the ECB, with many now seeing increased odds of rate cuts later this year if the industrial slowdown persists. Now, the analysis based on the news is that the actual factory orders below forecast is minus 1.4%. And this number confirms a sharp contraction in German manufacturing. This also highlights the fragility of the Eurozone's recovery and raises the risk of a prolonged slowdown. So you could notice a decline in the euro leading to a bearish move in euro USD currency pair. Now, the ECB is already signaling caution and slowing inflation. The downside surprise may add to the case for a dovish policy path, further weighting on euro sentiment. The broader context is the Germany's industrial sector has been under pressure from soft global demand, tighter financing conditions, and supply chain disruptions. With factory orders deteriorating faster than expected, the Eurozone's economic engine appears to be losing steam. Meanwhile, the US dollar remains supported by relatively firmer US data and the Fed's still cautious stance on rate cuts. Now, the key takeaways for Euro USD is the weaker than expected data. We got the minus 1.4%. That's bearish for the euro, and that is the reason why we got a drop in price action of euro dollar currency pair. Now, this highlights downside risk to Eurozone growth outlook, and market focus now turns to ECB guidance and upcoming US labor market data. The July 4th German factory orders report delivered a sharp negative surprise with a minus 1.4% reading, well below the 0.2% negative one. So the forecast was minus 0.2%, but the actual number we got is minus 1.4%. That's a surprise. The data reinforces fears of weakening Eurozone industrial activity and weighed heavily on the euro, sending euro USD lower. With the ECB likely to take note of this decline, traders will watch closely for any change in policy tone and continue to monitor incoming US economic releases for direction on the US dollar side. Next one is let's talk about the euro and US dollar Swiss franc. Regarding the euro dollar currency pair, we got quite an overbought reading with RSI in euro dollar in daily time frame. Even if I go over to a weekly time frame, the RSI is overbought. So as far as the technical analysis is concerned, I expect euro dollar to drop. The price action is probably going to drop in coming trading days. Regarding the US dollar Swiss franc currency pair, if you apply the RSI is oversold in weekly time frame as well as in daily time frame. So I expect USD Swiss franc to rise up from current levels. Next, let us talk about macroeconomic events and data releases for the current week. So the fundamental analysis, and this is what I'm going to present now. So official cash rate OCR related to New Zealand and the NZD USD currency pair. This is what we are going to discuss. The date and time is written over here, July 9th at 2 p.m. 2 a.m. UTC time. The next one is the unemployment rate related to Canada. And we're going to discuss USD-CAD currency pair. Date and time is July 11th, 12:30 p.m. UTC time. Okay, so let us start with the first one. Official cash rate, also known as OCR, related to NZD or New Zealand dollar. Now, what is the official cash rate? The official cash rate or OCR is the benchmark interest rate set by the Reserve Bank of New Zealand to influence short-term borrowing costs and maintain price stability. It is a primary tool for controlling inflation and steering the broader economic outlook. By raising the OCR, the Reserve Bank of New Zealand aims to cool inflation through tighter financial conditions. Conversely, a cut in the OCR is intended to stimulate the economy by lowering borrowing costs and encouraging spending and investment. Now, the July 9th, 2025, the report overview is the previous number we got is 3.25%. That's the cash rate, official cash rate. And the forecast is also 3.25%. The actual data not released yet. But market is expecting a no change. In other words, market widely expect the Reserve Bank of New Zealand to hold the OCR steady at 3.25%, signaling a wait and see approach amid signs of easing inflation and subdued economic growth. Traders will also focus on the tone of the Reserve Bank of New Zealand statement and forward guidance for future rate path clarity. Now, the possible market impact on the NZD USD currency pair is that if the OCR is lower than expected, like if the rate is going to change and it becomes less than 3.25%, then a surprise rate cut would suggest increased concern over slowing growth or disinflation. This would likely weaken the New Zealand dollar as price, it looks more dovish related to the Reserve Bank of New Zealand. The NZD USD currency pair could fall. Well, it's already going down, and you know if the NZD is going to fall, NZD USD drop is obviously going to reflect reduced demand for the New Zealand dollar. Now, if the OCR matches the expectations, 3.25%, or then it means that the Reserve Bank of New Zealand is going to hold the official cash rate at 3.2%. This would confirm market expectations, and this means we are going to get limited, or I would say sideways type of price action in NZD USD currency pair. Now, the NZD USD may remain stable or react to subtle guidance on future policy shifts. Now, if the OCR is higher than expected, like we get a change in OCR, and the change is going to be greater than 3.25%, then again that's an unexpected rate hike, and this would signal rising inflation concerns or stronger than expected economic resilience. This would likely boost the New Zealand dollar as investors anticipate tighter policy, and this means we are going to get a bullish leg in NZD USD currency pair, benefiting from increased interest rate differentials. So the overall analysis is the July 9th OCR decision will be pivotal for shaping expectations around the Reserve Bank of New Zealand's policy trajectory in the second half of 2025. While a hold at 3.25% is priced in, and any deviation or shift in tone could drive volatility in NZD USD. Uh, Forex traders will dissect the accompanying statements for clues above inflation, for clues about inflation, trends, growth risk, and the central bank's tolerance for maintaining restrictive policy. So the key takeaways for NZDUSD is if we get a lower than expected OCR, then it means uh, expect bearish price action, and NZDUSD currency pair is going to drop. And if we do not get any kind of change, like they keep the OCR rate at 3.25%, then it means expect a neutral or slight move. uh, Overall, I expect sideways price action if they are going to hold the OCR at 3.25%. Now if we do get a change, like the OCR rate changes to greater than 3.5, 3.25%, then expect a bullish price action, and the NZD USD is going to rise up. So the conclusion is, with the Reserve Bank of New Zealand expected to keep the OCR steady at 3.25%, the market focus shifts to future guidance. A surprise cut would likely weigh on the New Zealand dollar and push NZD USD lower. On the other hand, a hawkish tone or unexpected high could drive the NZD higher. As always, traders should remain alert to global risk sentiment and parallel moves in the USA monetary policy for broader context. The next report is the unemployment rate related to Canada, and we will get it on Friday, July 11th, 2025. Now, what is the unemployment rate? The unemployment rate measures the percentage of the Canadian labor force that is unemployed and actively seeking work. It serves as a key gauge of labor market strength and the broader economic climate. The Bank of Canada (BOC) monitors labor market conditions closely when determining its monetary path policy. A lower than expected unemployment rate typically indicates robust economic activity and may prompt a more hawkish stance supporting the Canadian dollar. Conversely, a higher unemployment rate may signal economic softness and could lead to policy easing, weakening the CAD and pushing the USD CAD higher. Now, the previous number we got is 7.0%. The forecast is 7.1%. The actual data not yet released. Now, the markets are anticipating a slight uptick in the unemployment rate to 7.1% in Canada, which would indicate some cooling in the labor market. However, even small deviations from this forecast can move the USD CAD pair significantly, especially in a sensitive macroeconomic environment. Possible market impact on USD CAD: if the unemployment rate is lower than expected, meaning less than 7.1%, then you will get a signal, or it signals the strength in the Canadian job market, and it reduces the likelihood of imminent rate cuts from the Bank of Canada. So expect CAD strength, and this means USD CAD, it may push lower. Let me show you the chart of USD CAD. Right now, the trend is clearly bearish in USD CAD currency pair. However, price action, it could change this trend as well. Okay, like we might get a bullish breakout, something like this. Okay, now if the unemployment rate matches the 7.1%, then it confirms a mild labor market deterioration. The market reaction may be muted unless paired with strong or weak employment change data. So USD CAD may stay range bound or react modestly to other data releases. Currently, I'm getting overall sideways price action inside USD CAD currency pair. So USD CAD may stage range bound or react modestly to other data releases. Now, if the unemployment rate is higher than expected, 7.1%, then it suggests growing weakness in Canada's labor market and increases the chances of monetary easing or a dovish Bank of Canada tone. So the USD CAD may weaken and sending the USD CAD higher. Okay. The overall analysis is the July 11 unemployment report will offer a critical insight into the health of Canada's labor market and will likely influence the Bank of Canada's future rate decisions. With inflation stabilizing, the Bank of Canada is highly sensitive to labor data, even if the rate prints in line with expectations. Market will look for clues in broader job numbers and participation trends. So the key takeaways for USD CAD is lower than expected unemployment rate. That's bullish for CAD, and expect a drop in price action of USD CAD currency pair. Higher than expected unemployment rate means that's bearish for CAD, and USD CAD is going to rise up. Now, if we do not get any kind of change, uh, you know, the neutral effect or the CAD is, it's actually going to go nowhere. The USD CAD consider is going to move sideways. Okay. So as of July 11th, 2025, the Canadian unemployment rate is forecast to rise slightly to 7.1%. While this is not a dramatic shift, any surprise in the actual data could significantly impact USD CAD. A stronger labor market result could strengthen the CAD and pull the USD CAD lower, while weaker data could increase expectations of Bank of Canada easing, driving USD CAD higher. Forex traders should also monitor broader employment figures and US economic indicators for additional context. Now, let us take a look at euro dollar and USD CAD currency pair charts. Now, regarding the euro dollar currency pair, it seems to me we got kind of a top over here inside a euro dollar currency pair. Price action is trying to drop over here. However, the trend is still up, and it is possible that we might get a bullish surprise in euro dollar currency pair. Regarding the USD CAD, price action is going sideways. Overall, the trend is down. It's a bearish trend going on inside USD CAD currency pair. So overall, it's a downtrend. But if you check out the smaller time frame, like go over to a 4-hour chart over here, you see the overall price action is moving sideways. Let me change the color to something like yellow. So overall, it's going sideways. We might get a bullish breakout to the upside or to the downside, but as long as price action is staying inside this trading range, uh, I think it's a good idea not to trade or not to look for any kind of trades in USD CAD currency pair. Next one is the New Zealand dollar NZD USD currency pair. NZD USD currency pair. If you check out the daily time frame, the RSI is not overbought. So we might still get a new high in price action, something like this happens. This, still looks possible. Okay. Next one is the spot gold. Okay, regarding the weekly time frame, the XAUUSD currency pair spot gold trend looks bullish, and price action just keep printing higher swing highs and higher swing lows. So overall, the trend is up. If you check out the daily time frame, there's an uptrend going on inside spot gold. So market is probably going to move sideways and then expect a continuation of an uptrend. Okay, so what you have learned today? Well, I discussed about the official cash rate OCR related to New Zealand. Then we discussed about unemployment rate related to Canada. And we also discussed about the euro dollar, USD CAD, NZD USD, and spot gold. So these are the assets you need to watch out for profits. Stay tuned for schedule of next week's trading webinar. What you should do next is you can subscribe to our social media pages. And if you want to learn more about trading, visit TradeGeek and access free trading courses for beginners, intermediate, and expert traders. Thank you for hanging around. See you at the next trading webinar on Tuesday, July 15th, 2025. So that's it for the time being from my side. Have a nice day and bye bye.